What's going on YouTube? Coin Capital here, and today I'm going to be going over the top 5 best ETFs for long-term holds in emerging industries. So these ETFs are going to be focused around new and upcoming innovations in industries that should do extremely well this year and along in the future. These ETFs have massive upside, and most of them are new. So let's get right into it. Before I start, I am not a financial expert. This is for entertainment purposes only, so trade at your own risk. Let's get it started with the first ETF on the list. The first ETF is the S&P Kensho Smart Mobility ETF. If you don't know what this ETF is about, the investment seeks to provide results that before fees and taxes correspond generally to the total return of the S&P Kensho Smart Transportation Index. Under normal market conditions, the fund generally invests substantially all, but at least 80% of its total assets in the securities comprising the index. The index is comprised of US-listed equity securities, including depository receipts of companies across developed and emerging markets worldwide that are included in the smart transportation sector as determined by a classification standard produced by the index provider. The fund is non-diversified. So, the kind of stocks you're going to see in this fund, as said, are going to be, transportation and emerging innovation companies within tech and transportation sector. And this is going to be like drones, new EV technology, hydrogen power. And the top 10 holdings for this ETF are Ag Eagle Aerial Systems, a stock that I really like and I featured on this channel before. That's a drone company. Plug Power, which makes hydrogen cells for cars. Ballard Power Systems, another like EV technologies. New Technologies, Blink Charging, Workhorse, Tesla's in there. Tata Motors, Neo's in there, another EV company. So a lot of big time big tech companies that are all the rage right now. And this ETF will see good growth this year. I think they have a year-to-date return of 20%, and the year just started, and they're about $65 a share with an expense ratio of 0.45. So not a very high expense ratio for an innovative ETF, because they have an average volume of around 200,000 and about 200 million in net assets, with about 3 million shares outstanding. They actually do pay a quarterly dividend of only 2 cents, which is very surprising for a ETF like this. But in the 1-year return, they've had over 117% return if you go over the past year, which is completely insane for an ETF. And very high performing ETF. They've only been on the market for a few years now, but not too much in assets, but definitely a good ETF to look into. Definitely something that should do well in the future. A high rate of return ETF. The next ETF I'm going to be talking about is Roundhill Sports Betting and Gaming and iGaming ETF. Very attractive right now in the markets. Their expense ratio is a bit high, of around 0.75. That comes with a very new and innovative ETF, but they're low in price at around $30 a share. And the investment seeks to track the total return performance before fees and expenses of the Roundhill Sports Betting iGaming Index. At least 80% or all the funds are invested in securities by the sports betting iGaming companies and is composed of exchange-listed companies that earn revenue from online gaming, iGaming, and betting on the phone. So definitely a big booming industry right now. And we've seen that so far because they've had a year-to-date return so far over 12%, which is pretty well. They haven't had one. They haven't been on the market for that long at all, but their net assets are a little higher at about 330 million, and they have more shares outstanding of about 11 million shares outstanding. Currently do not pay a dividend. They're a new ETF on the market, and they're pretty hot right now. The ticker is BETZ, if I didn't already say that. So it's betz, and their top holdings include Penn National Gaming, a stock that's been booming recently, as well as DraftKings, GAN Limited, and Rush Street Interactive Incorporation. So those are their biggest holdings, and those are all great companies that look out for this year. And this ETF provides more safety and less volatility when trading in the iGaming industry, so definitely something to look out for this year. The next ETF I'm going to be mentioning is the Global X Telemedicine and Digital Health ETF with the ticker EDOC. This is another cheap ETF at about $21 to $22 a share last checked, and the expense ratio is 0.68, so it's a bit of a high expense ratio, but these are new ETFs, so that's what you want to keep in mind. They seek to provide investment results that correspond to the price yield performance before fees and expenses of the selective telemedicine and digital health index. This index is designed to provide exposure to exchange-listed companies that are positioned to benefit from further advances in the field of telemedicine, medicine, and digital health, as well as biotech. Lend out by Selective AG, the provider of the index, and the advisor uses a passive or indexing approach to try to achieve the fund's investment objective. A non-diversified fund, but a great ETF to look at. Their top 10 holdings include Nuance Communications, Guardian Health, Illumina Incorporation, Neo Genomics Incorporation, Change Healthcare Inc., Allergen Technologies, and Insulin Corporation. They've so far had a year-to-date return of over 11% so far, and they're new to the market as well, so there's not much long-term data, but their expense ratio, as I said, is 0.68. They have a volume of around 235,000 shares, with a bigger net asset of about 804 million, so close to $1 billion, with 37 million shares outstanding, and they currently do pay a 1-cent dividend, which isn't really a lot, but that's what you want to keep in mind. They actually have net assets in the United States, Japan, Eurozone, Australia, and Asia. So all around the world, they have holdings in companies, and this stock should do extremely well because of telemedicine and digital health is on the rise, especially due to COVID and in the future. The next ETF on the list is a pretty popular one, one that's been featured a lot, and this is the Global Electric Vehicles and Autonomous Driving ETF with the ticker DRIV. They have an expense ratio of 0.68, and if we look at the ETF itself, they seek to provide investment results that correspond generally to the price yield performance before fees and expenses of the Selective Autonomous and Electric Vehicles Index. So that means about 80 to 100% of the holdings are designed to provide exposure to exchange-listed companies involved in the development of electric vehicles and or autonomous vehicles, including companies that produce electric and hybrid vehicles, electric and hybrid vehicle components, materials, and autonomous driving technology, as well as network connected services for transportation. These are all industries that are poised to do extremely well in the next few years and have done so far, and they are actually listed as number 4 in the miscellaneous sectors of ETFs. If we look at their top 10 holdings, we see Microsoft, Alphabet Inc., Google, Intel, Qualcomm, Apple, Tesla, Micron Technologies, Cisco Systems, Neo, and a lot of big EV and autonomous companies working on great innovative tech. And yeah, it's a very great ETF, and they're at about $27 a share. Year-to-date return is over 13%, and a one-year return is about 84%, so a high return so far. They pay a 2-cent semi-annual dividend, which is actually impressive, and they have an expense ratio, as I said, of 0.68%, with a volume of about 1.4 million. Their net assets total to about $711 million. And if we look at the weight of the fund, basic materials are 10% of the fund, consumer cyclicals is about 32%, communication services is about 6%, industrial is about 16%, and technology makes up for 35%. Their net assets are all over the globe. We see Asia, Australia, Canada, Europe, Japan, Latin America, United Kingdom, and with the biggest holdings in the United States of America. So a great ETF to look out for, especially if you like EV and autonomous technology, which I think will be the future of cars, which is an extremely lucrative industry. So that's why I picked that ETF right there. The final ETF I'm going to be mentioning is a cannabis ETF. There's actually quite a few new cannabis ETFs on the market, but the one I'm talking about in particular is called the cannabis ETF with the ticker THCX. Their expense ratio is about 0.7%, and they seek to provide investment results before fees and expenses that correspond to the total return of the Innovation Labs Cannabis Index. So 80 to all percent of their securities. So 80 to all percent of their securities are investments within common stocks with the American depository receipts of cannabis companies, as well as just different hemp and cannabis derived companies. And the index is a proprietary rules-based index designed to track the performance of a portfolio of cannabis companies. They're a non-diversified fund, and what I like about them is their top 10 holdings. We see Grow Generation, Village Farms International Inc., Canopy Growth Corporation, Afria Incorporation, Kronos Group, GW Pharmaceuticals, Scott's Miracle Grow Company, Tilray, Amaris, and the First American Financial Corp. A lot of big names within the cannabis sector, and definitely some great companies on that list. They've had a year-to-date return so far of about 50%. Cannabis has definitely been booming recently within the past few months, and a one-year return of over 60%. They're at about $20 a share, so you want to keep that in mind. They're pretty cheap, and they pay a 5-cent dividend quarterly, which is nice. They have a little over 111 billion in assets. Not too many assets, but great assets thereof, and they have a volume of about 730,000 shares. If we look at their fund weight, 9.8% basic materials, 9.2% is consumer defensive and cyclical, 68% in the healthcare, 2% in industrials, 2% in technology, and their holdings consist of the United States, Canada, and UK. Definitely big cannabis areas, which is great when looking for this ETF. So that's the final ETF, cannabis. I think cannabis should do extremely well with new lawmaking put in place, especially in the US. So those are the top 5 great long-term plays for ETFs. Thank you so much for watching. Make sure to like, follow, comment, and subscribe. I'll see you guys in the next video. Check out my TikTok and my Instagram at CoinCapital. Alright, I'll see you in the next video.